John, we've been covering the 3 parts to a perfect estate plan.
We have.
It's been a good series that we've done where we've covered a lot.
Listeners seem to like it.
Oh yeah, we're getting a lot of questions in about it,
Mm-hmm.
and we are covering some of those questions now because we're in the middle of these series. So some of those are getting moved to the front of the line. But I did think that it was important for us to cover some of those questions while we are in the midst of talking about this, instead of waiting for 6 months like we do on some of our other questions.
Right.
So in the first 3 episodes that we've covered in this series, we've talked about a number of things. And to our listeners and viewers, if you haven't watched or listened to that yet, you need to go back and check that out to lay the groundwork for what we're going to talk about today. We talked about planning for incapacity with powers of attorney, paying for long-term care, some of the pitfalls and mistakes that are there. And then in the last episode, we moved on to talk about non-probate transfer strategies. And we covered that in depth.
Yep.
And so that was the 3 parts to a perfect estate plan. Part 2A today is going to be the 3 parts to a perfect estate plan. Part 2B.
There you go.
And we'll see how many more episodes we have left to cover these 3 parts.
And
But
this
we're
is
going to
good-
pick
this
up
is-
today.
Yeah, this is going to be my favorite because we get to talk about taxes.
Yes.
Everybody loves taxes.
It's always a lot of fun to talk about taxes, and it's very poorly understood as well, especially when we start talking about death taxes, estate taxes.
correct.
So many people do not understand how that works. We're going to talk about stepped-up basis and capital gains. We've got several good things coming up today. So let's dive right into this.
Yep.
And pick up where we left last week, which is now you're past incapacity, which means you've died, and now you're into passing your estates on to your heirs, your beneficiaries, and now we're talking about how is that going to impact them or impact your estate for taxation.
Right. Yeah. So we're going to hit lots of different tax situations here, and we'll just see how much we can cover. And we might miss some stuff, and if we do, then you'll ask questions.
Our listeners tend to call it out.
They will. So, but let's start with the one that's the big one, and that's the federal estate tax.
Yes.
And part of the problem here is, as we're having this conversation, we're in a bit of limbo.
A little bit.
But I'll tell you what.
Let me throw something in there, John.
Yeah.
As long as you and I have known each other, we have been in limbo, though, it seems like.
We have.
Right? It's always uncertain what's going to happen with estate taxes and with the exclusion amounts.
That's right. Well, anytime you're dealing with something that is going to happen in the future, right? So we have laws that are on the books today, but we have an event, your death, that's going to happen in the future.
Yeah.
And things are going to change because the laws will change based on whichever pack of fools happen to be in Washington
Right.
at any given moment.
Yes.
Right? And there's no right or left side of that. It's just
Right. That's
whatever pack of fools happen to be up there at any given moment.
Yes.
We just know that it's going to change.
Right.
The problem we have right now is we have a change on the horizon
Yeah.
that may or may not be there in a few months.
Right.
So I'll tell you what the law is today.
Mm-hmm.
So when we're talking about the estate tax, the first thing we have to understand is this is a tax on the estate. This is not a tax on the beneficiaries of the estate.
Right.
Right? Generally speaking, inheritance comes to the beneficiaries tax-free. I say generally because we'll talk some more about that. But generally speaking, like if I die and I leave you $100,
Mm-hmm.
you get $100.
Yeah.
You don't pay tax on that $100. I had this conversation with a family yesterday, and they just could not wrap their minds around the fact that dad has died. There's $300,000, and I'm talking to the executor, and I'm like, you're going to give each person $100,000. And he's like, well, how much tax do they have to pay on that? Nothing.
Yeah.
But what do they report on their tax return? Nothing.
Well, and John, I opened this episode up by saying this is a poorly understood area.
Yeah, and he just was having a hard time thinking that somebody is going to put $100,000 into their personal account and doesn't have to tell the IRS about that. That just was contrary to his thinking.
Yeah.
But it is not a taxable event, right? So there is a death tax, but it applies to the estate. So it's taxed before the money leaves. right? Before it goes to the beneficiaries. But the death tax only applies to an estate whose value is in excess of $13,990,000. So to this family, I was like, look, he was like, you're telling me that if I died and in my will I left you $1 million, that you don't have to tell anybody about that. I was like, that's what I'm telling you. I said, but now let me change your scenario. Let's say you died and you left me $15 million.
Mm-hmm.
Well, I don't have to tell anybody about the first $13.9 million, right? But your estate is going to have a tax on everything above the $13.99 million.
Yeah.
All right. So that's the federal estate tax. Now, this tax is based on what the IRS considers your gross estate. Our last episode, we talked about what goes through probate, what doesn't go through probate.
Mm-hmm.
And I made a big deal in that episode that your, quote, estate is only the assets that go through probate.
Right.
And that in many cases, your estate can be completely empty because everything passed outside of probate. In fact, that should be your goal. Right. Pass everything outside of your estate. My definition of estate when we were talking about probate versus non-probate is totally different.
Yes.
Than the definition of estate, excuse me, when we're talking about your gross estate for federal tax purposes.
Yes.
Gross estate is basically everything.
Right.
Everything and then some.
Mm-hmm.
If you have an IRA, it's part of your estate. Your house is part of your estate. Does your IRA have beneficiaries on it? I don't care. It's part of your estate.
Right.
A couple of ones that people often don't know about. The death benefit of life insurance is part of your estate. Mm-hmm. If you are a hobo just riding the rails, I saw something the other day. I've always used hobo.
You have.
One, it's kind of a fun word.
Yeah.
Hobo. But I saw something the other day, and it was talking about the difference between a hobo, a tramp, and a bum, I think is what it was, or something like that. But it was like these three different terms, which I always really just kind of considered them synonymous, but they're apparently not.
No, they're not the same. The difference is methamphetamine.
That was not, in fact, the difference.
Oh, that's not the classic.
But it was something about like a hobo travels, but will do work occasionally.
Oh, okay.
Where a tramp will just do enough work to get by or something. Anyway, there was an actual definition of the terms. For my purposes, we have a hobo, they don't make any money.
Right.
But somehow they're able to afford a $15 million term life insurance policy. All right? That person has a taxable estate. Even though they have no money to themselves, there's no cash value in that life insurance, but the death benefit is part of their taxable gross estate.
Yeah.
And since it's over $13.99 million, they have a taxable estate.
Yeah.
All right. So that's the federal death tax. Now, in addition to the federal death tax, some states have a state death tax. Texas, not one of them. Arkansas, not one of them. New York is one of them. So some states also have a state death tax. And you really need, if you live in a state with a state death tax, you really need to understand the rules on how those apply. Because let's take the federal estate tax. If you have a $14 million estate, so you are $10,000 over the limit, right? You're going to pay tax on that $10,000. Mm-hmm. So it's only the amount that's above the exemption.
Right.
New York has a state death tax. And the last I looked, it was at $5 million. It may be adjusted for inflation, so it might be closer to $7 million right now. But we'll just use $5 million for my example. But it's a cliff.
Oh, wow.
So if you have $4,999,000 estate, you pay no New York estate tax. If you have $5,001, you pay New York state estate tax on the whole $5 million.
That's insane.
Right? $1 over the cliff, and the whole amount becomes taxable. So that's one of those things where you're looking at your estate and you're saying, well, I have a $5 million estate, so I don't have to worry about the federal, and I'm right on the line for New York.
Right.
Well, right on the line for New York's a big deal, because if you were thinking, well, hey, if I got $5 million and $10, I just got to pay tax on $10. No, that's not how the state one works.
Yeah. Right.
So if you live in a state that has a state death tax, you've got to make sure you understand how it works.
Yeah.
And I'm not going to go state by state on all of that. So that's the death tax.
And the majority of people under current law are not going to be impacted by the federal estate tax, because that $13.9 million is for a single person.
That is.
And so for a couple, you double that.
Well, sort of. So the exemption is a per person exemption, right? But let's just say, for example, let's say, Devin, you and Karen, y'all have a $15 million estate.
Mm-hmm.
You die, you leave everything to your spouse, right? So there is what we call an unlimited marital deduction.
Mm-hmm.
So as long as you're leaving assets to a spouse, there will be no tax on the death of the first spouse. Period. End of story.
Yeah.
We also didn't need to use any of your exemption amount because you left everything to your spouse. So unlimited marital deduction. So your estate was, for tax purposes, was zero, because everything you left to your wife was a deduction from your gross estate.
Yeah.
Now Karen has a $15 million estate.
Mm-hmm.
She only has a $13,990,000 exemption.
Right.
If nothing else happened, there is a tax at her death.
Yes.
So it's not doubled.
Right. And I guess I'm thinking of, in the very unlikely circumstance that we are both up flying around in an airplane, we have a net worth of that $15 million, and the airplane crashes and we both perish.
Well, even there, potentially.
Oh.
What does this situation is addressed in your estate planning, because I drafted it.
Yes.
So what does it say?
Well, heck if I know. I'd have to read the stupid thing, right?
So there's a survivorship situation.
Yeah.
Right? Who outlived the other?
Right. Yeah.
Because if, for example, let's say that your planning said that in the event of a simultaneous death, then if you're looking at Devin's share of the estate, you should presume that he died first.
Okay.
Well, then that meant everything went to Karen.
Yep.
And now we're just looking at Karen's estate, who has $15 million, in which case we kind of screwed that one up.
Yeah.
If, on the other hand, we said, well, if we're looking at Devin's estate, we'll presume that Karen died first.
Mm-hmm.
So he's single. And if we're looking at Karen's estate, we'll presume Devin died first, in which case she's single. Right now, we've maximized the two.
Yeah.
In the event of the simultaneous death. That's actually what yours says, by the way.
Yeah. Now I know.
Now you know. But back to my point, but what if you didn't die in the plane crash? It's like you died, and then she was just so heartbroken that 3 months later,
mm-hmm.
she died of just loneliness.
Yeah.
Having lost her Devin, right? Which... it's either that or she's married Carlos the pool boy and brought him to your funeral. But let's just say that it's the first one.
Yes.
Well, now there's certainly not a simultaneous death, right?
Right.
So this brings me to portability. When you died, we did not need to use your exemption. So you had what we call unused exemption amount, or the DSUE.
Mm-hmm.
Or DU.
DSU. Yep, that's it.
Yeah.
Yeah.
Yeah. Basically, the decedent's unused exemption amount.
Yeah.
Right? And there was a law put in, I believe, during the Obama administration that allowed what we call portability. And that's where you can transfer the unused exemption amount from the first spouse to the second spouse. So now that requires the filing of a Form 706, a federal estate tax return. So even though there was no estate tax due, There was actually no requirement to file an estate tax at your death. But if we don't file that 706, Karen doesn't get your unused exemption amount. Generally speaking, you have to file that return within 9 months of the date of death, or you can extend it for an additional 6 months. So you have a 15-month window. However, if the only reason you're filing the 706 is to make a claim for portability, you can do it within 5 years. There's a special revenue ruling that allows you to do it for up to 5 years. I visited with a family here recently. The lady that I'm talking to, her husband died 3 years ago, and they don't have anywhere close to a taxable estate. However, she is a beneficiary of her aunt's estate, and her aunt has a very large estate. And so although she doesn't have an estate tax problem now, she may very well, when her aunt dies and she inherits this money.
Yeah.
And so I had suggested to them to go ahead and file the 706 and elect the portability, and that way she can get her husband's unused exemption added to hers.
Yeah.
That way she'll have that doubled exemption amount, and then when she receives this inheritance and her estate is much bigger. I can make a pretty good argument. If you've got just about anything at all, it's not a bad idea. If you've lost a spouse inside the last 5 years, file the 706 and claim the portability. Maybe you've got a $5 million estate. You're thinking, meh, I'm nowhere close to the death tax situation. So why should I do it? In fact, you even asked your CPA.
Yeah.
And your CPA said, meh, don't worry about it. Unnecessary.
Right.
You're never going to have an estate tax. Well, don't tell me never.
Yeah.
You don't know who's going to be the next group of fools in Washington.
Right.
Given the rate that this country is spending money and our deficit, I think one thing we can all agree on is they're going to need revenue. Dead people don't vote, so estate tax is a way to raise revenue without necessarily triggering a rash of mad voters.
Right. Yeah.
Right. And so, just during the end of the Biden administration, Bernie Sanders had proposed reducing the exemption to $3.5 million. Right. Well, that person with $5 million would then have a problem. Right. So if on the other hand, that person with $5 million had their dead husband's $13 million exemption added to theirs, well, right now, then they would have $27 million and their $5 million estate. But let's say that 3 years from now or 4 years from now or 10 years from now, the exemption was lowered to $3.5 million. That lowers their exemption, but the portability amount never lowers.
Interesting.
It's frozen at the date of death.
Yeah.
So their exemption goes down to $3.5 million. They still have the 13 from their dead spouse.
Yeah.
And so the way I explain it to them, and I'm talking to the person in front of me, and I say, you have a $5 million estate, likely to never have a death tax problem. But if we do this portability, you're never going to have a death tax problem.
Yep. You're going to buy yourself so much buffer that, unless you hit the next NVIDIA and you put it all there.
Right. So I can make a pretty good argument that you should be doing portability.
I absolutely agree.
And if you're just finding out about this, but you lost a spouse 3 years ago or 4 years ago, or maybe your parent has lost a spouse in the last less than 5 years, you still have time.
So there's a 5-year period that you can do this if it's just for the
if you're just electing the portability.
And when does that 5-year period start?
From the date of death.
Date of death, 5 years forward, you could file the 706.
That's right.
Okay.
If you're just electing portability. Yeah.
Perfect.
Better if you can do it within the first 9 to 15 months of date of death, but even if not, you can do it all the way out to 5 years. And it's a relatively simple form.
Who would file that for you?
Many accountants will do it, although many won't. For example, the CPA that I use to do my payroll taxes and stuff like that, he will not touch a 706. Period. He just won't do them. Also, many lawyers, estate tax or estate planning attorneys who deal with taxable estates often will do the 706s.
Yeah.
So I do them, for example. The thing about the 706 is there's this weird combination of law, is the intersection of law and accounting. And so the reason a lot of CPAs don't necessarily want to get into it is because there's a level of legal knowledge that they don't have.
Yeah.
There's a reason why a lot of estate planning attorneys don't do them, because there's a level of accounting knowledge that they don't have.
Yeah.
And so you're trying to find the one that where you've got a Venn diagram between those two circles.
Right. I know. It's almost like if only there was an estate planning attorney that did their undergrad in accounting.
Right. Exactly.
Wouldn't that be perfect?
Yeah. But I will say, this is not a...
Which, by the way, for those who haven't listened and don't know, that defines you to a T.
It does. It does, in
Okay.
fact. And my wife, for that matter.
Oh, yes. That's true.
But again, the 706, when you're just electing portability, is not a hard return.
Okay.
It's not something you could probably DIY
Right.
necessarily, because it's a wonky little booger.
TurboTax may not cut it.
TurboTax ain't going to get you there.
Yeah.
It is a wonky little booger. So you're going to need some professional software, which means you've got to go to somebody who has the professional software. But I just, this one that I just mentioned, right, that I did for this lady, it took me longer to do the data entry than really just about anything else. And when I say the data entry, I mean like, client's name, social security number, address, type, decedent's date of death, decedent's social security number, decedent's date of birth, what county was the will admitted to probate in, what's the estate's tax ID number, and just the data entry.
Yeah. Right.
When you actually get to it, you don't even have to have actual values.
Mm-hmm.
You can estimate the values on the estate as long as you're within a range.
Yeah.
So you don't have to provide appraisals. Like if you say, well, my house is worth about $1 million. Okay, that's fine. Just put $1 million in there. You don't have to go get the house appraised. Now, if you have a taxable estate, if you've got a $15 million estate, you got to go do the appraisals and stuff, right? You've got to be much more specific about it because the IRS is expecting some money.
Oh, for sure. And they want the right amount of money.
But when you're just electing portability, you're saying, look, there's not a situation where there's going to be a tax due here because everything went to the surviving spouse.
Yeah.
And because of that, I don't need to provide you values, not hardcore values, just a rough estimate of the values. And there you go. So it's a pretty simple return.
Yeah. Good. Well, I'll bet it's simple for you.
Yeah. It's not it shouldn't be too intimidating, even for your CPA that maybe they've never done one.
Yeah.
But the professional software is good enough. It should walk them through it for the most part.
Yeah. So effectively, the federal estate tax isn't something that's going to be too impactful for a lot of people, at least now under the current rules.
That's right.
So we have some they're not proposed changes. It is the change that's already written into law unless something happens.
Right. So when Donald Trump became president the first time, he doubled the exemption from what it was under the Obama administration. So under Obama, it was $5 million with an inflation adjustment. Trump came in and doubled it to $10 million with an inflation adjustment.
Right.
But he put an expiration date in that law. And that expiration date is 12/31/2025.
Yep.
This year.
Oh, yeah. We've been talking about it now for the last few years, and yet here it is.
And here we are. So if nothing happens at the end of this year, the Trump's Tax Cuts and Jobs Act expires, and the estate tax exemption would revert back to what it was under the Obama administration, which would be the $5 million adjusted for inflation. Now, adjusted for inflation from Obama's presidency to January 1st, 2026 would put it at about $7 million.
Right. Yeah.
So that's what the way the law is right now. If you say, what is the law today? It's $13,999,000 for the next several months. And at the end of the year, it's going to go down to $7 million.
Mm-hmm.
But then you've got to look at the collection of fools that we have in Washington and at any given moment, right?
Right.
Well, at the current moment, Trump's back.
Mm-hmm.
And he's got control of both the House and the Senate.
Yep.
So my best guess is he would be able to get an extension or perhaps even making that exemption permanent beyond the end of the year.
So I know that the Trump administration has voiced that getting the Tax Cuts and Jobs Act made permanent or at least extended for another period of years is one of their top priorities.
It is.
But the way it has to work back through the legislative process, just because that was a component of the prior legislation, does not necessarily mean that it's going to be a piece of the future legislation. Now, I haven't been keeping up with the details, so I don't know if, and I don't believe they've released any proposals for what they plan to do, this year. But they are planning to take some action in 2025 to get this made more permanent or at least extend it.
What I have seen is and this is typical Donald Trump, but he has the big, beautiful bill.
Yes.
And in the big, beautiful bill is making the $14 million exemption permanent.
Okay. So that has been discussed as being part of any tax legislation that goes through.
Yeah.
Okay.
But this and so this is going to be a good segue, I think, because we can't get into all of the details on the estate tax. We just want to tell you, this is something you got to know about.
Right.
But Representative Massey, I can't remember if he's a representative or a senator. I think he's Representative Massey. He put up a bill just in the last several months that would repeal the estate tax altogether. Now, the question for people out there, let's say you have a $5 million estate, right? And you're thinking, well, the estate tax doesn't apply to me. So, whether we have an estate tax or don't have an estate tax is really irrelevant to me.
Yeah.
It would seem right?
Yeah, it would seem like it. Yeah.
Wrong. You're wrong again.
Yes.
Wrong again.
Again. Dang it. John's proved me wrong again. His goal in every recording episode.
That's right.
Prove Devin wrong.
Wrong again. But so here's where I buy a house. I pay $100,000 for my house. I live in the house for 4 decades. And at the time of my death, the house is worth $500,000.
Yeah.
It's got $400,000 worth of appreciation. Now, when I die and I leave you my house is part of my taxable estate.
Yeah.
Now, because I have a $13 million credit against the death tax, there's no tax due. But the house was still taxed, right? So this is something that's kind of hard for people to necessarily wrap their heads around. So the house was taxed at my death. It's just there was no bill due to the IRS because of the credit.
Yes.
Make sense?
Yep.
But when an asset is taxed, it gets a new basis.
Yeah.
So my basis was $100,000. Fair market value was $500,000. But since it was part of my taxable estate and taxed, when you inherit the house, you got a new basis, the fair market value on the date of death.
Right.
That's a tax benefit. Because now you could turn around and sell that $500,000 house for $500,000. Sales price, $500 minus your basis, $500 is zero. If you repeal the estate tax altogether, then that house was not taxed when I died.
Right. True.
If it's not taxed when I die, my basis would carry over to the heirs.
Yeah.
In which case, you would not get a step up in basis at date of death.
So very interesting. Effectively, by repealing the federal estate tax, you are also completely doing away with the step up in basis.
That's correct, generally speaking. So to that person with a $500 or $5 million estate, right? Well, they don't have to worry about the death tax, paying a death tax. But if you were to repeal the death tax altogether, if they have a lot of appreciation in their $5 million estate and there's no step up in basis at death, their heirs are likely going to incur a significant tax bill when they realize gain on those assets, when they sell mama's house, when they sell her brokerage account that has all that NVIDIA stock in it, or whatever the case is. So you've got to understand the difference here between the pros and cons of a taxable estate and the pros and cons of the step up in basis. You get one or the other. You don't get both, right? I mean, it's and this comes into when you start doing the planning, it can make it very difficult. Now, I will say real quick that prior proposals to repeal the death tax have included a flat step up in basis. So they say, well, there's no death tax, but the heirs get a step up in basis up to $1 million or something like that. So they try to compensate for it to a small extent usually.
Yeah.
But generally speaking, repealing the death tax would actually generate more taxable revenue.
Interesting. Yeah.
As crazy as that sounds.
That does.
Because it impacts the
right.
estate tax only impacts a very small number of people.
For sure.
Most of those people have the kind of money that they can pay very sophisticated lawyers to get them out of the death tax. So the death tax generates very little revenue.
Yeah.
Especially compared to how much it costs to administer the program. Repeal the death tax and people not get the benefit of a step up in basis, that impacts 99.92% of the population.
Yes. Yep. It really cast a much larger net.
And so that would actually generate a lot more revenue than the death tax.
Yeah.
Now, it impacts, depending on your sociology position, right? You could say, well, that's good for government because it generates a lot of revenue. You could also say, yeah, but it also generates that revenue from the bottom 99%, not the top 1%.
Right. Yeah.
So anyway, those are the pros and cons on it. But you've got to know how all of these things work. We did a listener question here recently, just to, and one of the people on there, and I've got it here in front of me, but it was Sandy, and she was the one that asked about her umbrella policy.
Yeah.
Right?
Had the $2 million umbrella policy.
Yeah, she had asked about that. We answered that question. But one of the things she said, there was a little note in here, and she said, because she was worried about her house, and she said, our house, worth $1 million, it's appreciated 4 times what we paid for it, and we don't want to lose the step up in basis to the date of death, right?
Yeah.
So she's recognized this, right? She knows that if she passes that, and what she was probably thinking was that if we needed to protect the house, we would have to put it in something like an irrevocable trust. And if we put it in the irrevocable trust, we wouldn't get the step up in basis.
Yep.
That's actually not true. It could be true, but not necessarily true.
Yeah.
You can structure trusts so that the assets are included in your gross estate or not included in your gross estate, depending on what your goal is. And so, for example, Devin, I could create a trust that is for you. So I'm not a beneficiary of the trust. I'm not even trustee. You're the trustee of it. So I'm not in control of it. I'm not a beneficiary of it. And it says that as long as I'm alive, those assets are yours. You're the trustee. You use them how you see fit.
Yeah.
And when you die, or when I die, whatever's in the trust goes to you. Party like a rock star. But In the trust, though, it says that John, even though he's not a beneficiary of the trust, he's not the trustee of the trust, if he wanted to, he could add a charity as an additional beneficiary. He could change or he could even maybe add another beneficiary besides you.
Mm-hmm.
Or maybe I say, I'm going to put all these assets in a trust. They're for you. You can do with them what you want. You're the trustee. You're the beneficiary. But if you want to take a distribution, I can veto it. That's it. That's the only reserved power in the whole trust is that I can veto a distribution to you while I'm alive. That trust and those assets are going to be part of my gross estate when I die.
Yeah.
Which means those assets are going to get a step up in basis when I die.
Yeah.
So if I wanted to protect this house, for example, from my liabilities, well, if I put it in this irrevocable trust that's for Devin, well, certainly if I get sued, they can't get it because it's not mine. It's in a trust for Devin. It's also not subject to Devin's creditors because it's in a trust for Devin, not Devin's.
Yeah.
But I want to get the step up in basis because it's appreciated 4 times its value. So I want the step up in basis. When I die, I just reserve one of the powers that would cause it to be included in my gross estate. And bam, I get a step up in basis. And if you understood any of that,
we were having that conversation not long ago with a client case, and as I remember that, it came to the power of appointment was one of the key powers that made the determination. But it sounds like there may be some other additional or ancillary powers as well.
Yeah. So for the engineers that are listening, because they're going to want to know all the details.
Yes, all the details.
Take a look at Internal Revenue Code sections 2036 through 2041. Those sections, IRC 2036 through 2041, are the statutes that govern estate tax inclusion, whether or not an asset will be part of your taxable estate.
Yeah.
And so you can look through those statutes and you can see what are the conditions, And so, for example, one of them is the power to control beneficial enjoyment, right? So I've put these assets in trust for Devin. Devin's the trustee, Devin's the beneficiary. But I can veto a distribution.
Yeah.
Well, if I can veto a distribution, then I'm controlling your beneficial enjoyment. The retained power to control beneficial enjoyment is going to cause that to be included in my gross estate under one of those sections. Right? And there's lots of them. The power to vote on a controlled corporation, right? I mean, there's some random ones in there, but there's a number of them. And so you can use these statutes to either include the powers so you get the step up in basis, or exclude those powers so that the assets are not part of your taxable estate.
Yeah.
What are you trying to accomplish? Do you want the step up in basis or not?
Yeah. I remember Sandy saying, love your podcast. I'll never miss an episode. So now that she's listening to this episode, heck, who knows? This episode may come out before
the listener question. Yeah. In which case, Sandy, guess what? Yeah. We did one of your questions.
Yes, we did. But I'll bet her ears are perked up right now, because the idea that you can use an irrevocable trust and still get that step up in basis.
Yes.
That's an interesting thing.
So you've got to understand how these things work in practicality, because you can't just, and I can't tell you how many times I've had CPAs, other lawyers, random people off the street, and but they have this preconceived notion. Well, yeah, but if I use an irrevocable trust, I'll lose the step up in basis.
Yeah.
Or if I use this irrevocable trust, the assets in the trust are going to get taxed at a higher rate. Again, you're talking about general rules, but not exceptions to general rules.
Right.
And there's always exceptions to these general rules. So can I have an irrevocable trust that's not taxed as a trust? Yes. Can I have an irrevocable trust that's included in my gross estate, even though it normally wouldn't be? Yes, I can. I just have to include the right powers. And all of that goes to making sure you're doing these things the way you want them to be done.
Yeah.
So all of that was the interplay between the death tax and the estate tax and the step up in basis, right? Critical to know all of that. Can't get into much more detail or else we'd be talking about it forever, because there's probably one other thing, and that was at the very beginning when we were talking about the overview of the estate tax. I said there's no tax on the inheritance, right? I lied.
And discovered it in the same episode.
Well, I didn't lie, because I did say generally there's no tax.
That's right. That's a good lawyer term. I have picked up the use of the word generally from you, by the way. In my writing, I will use the word generally a lot.
Yes. But that way I can always point out that generally that's the case. So might be an exception in
yes.
there. Well, income in respect of a decedent, IRD. This is the IRS term for money that is going to be taxable to the beneficiaries. And it generally is going to come in one of two forms, IRA and other pre-tax accounts and annuities.
Yeah.
And so, basically the IRS going to get their piece.
Right.
Right. And so if you have annuities that have a bunch of untaxed gain, and if you have IRAs and 401ks where no tax has been paid on those dollars, you got to figure the IRS going to get their piece at some point. Those are going to come taxable to the beneficiaries. We have done, particularly on the IRAs, we've done whole episodes on the Secure Act, different methodologies on how to, using a charitable remainder trust, for example, as a beneficiary to recreate the stretch on an IRA. Right. I would just encourage you to go back and look at those.
Yes.
That way we're not having to go through all of those details. But on this whole section, so 2B.
This is 2B.
Part 2B, you got to know the tax consequences.
Right.
You're looking at your estate. Do you have a taxable estate for death tax or not? Do you have appreciated assets or not? And then how do you make sure that these assets are going to pass in the most tax efficient way? Do you have IRAs or not? Do you have annuities or not? All of these things have potential tax consequences, some of them hidden. IRA is a pretty obvious tax consequence, but some appreciated stock is a kind of a hidden tax consequence.
Right.
Because if you don't get the step up in basis for some reason, then that's a tax consequence. It's not readily apparent.
Yeah.
So you want to know how all of those things work, and you want to plan your estate accordingly.
Excellent. Now, is there going to be a 2C?
I don't know. Do we need a 2C?
Well, talking through so much of this we've covered in the past. So, for example, we're talking about beneficiary designations and keeping those updated. Relying solely on joint ownership.
Some of the mistakes, right?
Yeah. There's still some meat to cover here, but a lot of this is material that we've covered in prior episodes as well. But I almost hate to move on through this, because this entire section was about passing your estate, right? So what we may do is just catch it at the beginning of the next episode. We'll
see how long that takes. It may be a whole C.
It could be.
It could be a whole C.
We could have part 2C. But we do need to wind this up, because we are at, goodness gracious, we're at over 40 minutes now.
Yeah, so we don't need to get into anything more at this point. But yeah, we've got some common mistakes.
Yeah.
And we've got some best practices.
Absolutely. Yeah, very good. Well, let's wind it up right there.
So
listeners,
we'll get to those next.
And viewers, thank you so much for continuing to listen to our show and leaving us those reviews. We've got those that are constantly coming in on the Apple Podcast is the best place to leave those. It's always nice to see those, John. Those reviews that come in. And since we're already over time, we're not going to read any. Just thank people for leaving those.
That's right. There
5-star
must not
rating
be any
and
really
review.
good ones this
Oh,
time.
no, there is. There's a couple of really good ones.
Okay.
But we're hitting our time.
All right, we'll just go on to the next one.
So very good. All right. Well, until next episode, thank you for listening.